from adjusted earnings to earnings power value. We have expressed skepticism about the ability of analysts to derive with sufficient precision the rate at which the earnings of a company should be discounted to calculate a useful earnings power value. In our current case, we are looking at Intel's earnings over a period in which long-term interest rates fell from around 12% to under 7%, the risk-free rate from more than 13% to under 6%. Because the company rarely had any debt on its books, a debt left after deducting cash and short-term investments, its weighted average cost of capital would not have benefited from the fact that it costs less to borrow than to raise equity, especially after the deductibility of interest payments for tax purposes is taken into account. Thus, as in the case of WD-40, the appropriate cost of capital would be the cost of equity. In the late 1980s and early 1990s, the returns that venture capitalists expected to earn and felt they had to earn to attract funds were between 16 and 18%. Long-term BAA debt paid an average of about 9%. The cost of equity for Intel at that time would have fallen within this range. With an established but threatened core business, Intel equity represented a substantially riskier investment than WD-40. But with low leverage and a long-term history of success built around that core business, the risk would have been well below that associated with venture capital investments. At the time, cash returns on equity market investment as a whole were about 3% if we add 4% for real growth and another 3 to 4% for inflation. We would have an estimated overall stock market return of 10 to 11%. Assuming an investment in Intel was a slightly higher than average risk level, the cost to Intel of attracting capital voluntarily would have been around 12%. We will use this figure to discount Intel's earnings. With our earnings power, adjusted after-tax EBIT, and discount rate in hand, we are almost ready to calculate an earnings power value for Intel. Before we compare that figure with the asset and market values, we will need to make one more set of adjustments. Both the asset value we calculated and the market value we are citing refer to the equity portion of Intel's capital and exclude the debt. We specifically subtracted this debt from the reproduction value of Intel's assets to arrive at the asset value. To be consistent, we need to do the same thing here and reduce earnings power value by the amount of the debt outstanding. On the other hand, Intel had a lot of cash on its books in these years, substantially more than it needed to run the operations. When we did our asset valuation, we included this cash hoard. Since we did not build this extra cash into the earnings power, operating earnings omit the interest on cash balances, we should add surplus cash to the earnings power value. This cash is definitely incorporated into the market value of the equity. Anyone buying the whole company would own this money along with all the other assets. Our cash and debt adjustments, which make all three values comparable, will be to subtract the book value of the interest-bearing debt and to add back all cash. With these last modifications, we arrive at these figures for Intel during the period 1987 through 1991, shown in Table Example 4.8. Figure Example 4.6 displays these values and extends them back and forward a few years to illustrate the transformation of Intel in this period. We have already seen that the mid-1980s were a time of instability and transition for Intel. This is reflected in the greater fluctuation in earnings power value compared to asset value. But the critical point here is that for the years 1987 and 1988, Intel was trading at and slightly below net asset reproduction value and the average earnings power value at $3.35 billion was essentially equal to the average asset reproduction value of $3.31 billion. Intel's management did indeed seem to be making efficient use of Intel's assets, a conclusion generally confirmed by our qualitative review of Intel's management behavior. Any downside to Intel's value during this period was largely protected by the value of the company's assets. Under these circumstances, an investment in Intel based on future developments whose value would have been impossible to measure precisely, but whose average expected value would have been significant, would have been fully justified. In the language of Graham and Dodd, it would have been an investment and not a speculation. Intel as a growth stock. As Intel's earnings grew with its dominance of the microprocessor industry in the 1990s, its stock price also rose rapidly. By the late 1990s, Intel's market value was typically between 4 and 6 times any reasonable estimate of the reproduction value of its assets. Making an investment in Intel during this period would not have been justified without earnings well in excess of those supported by Intel's assets and significant value attributed to the continuing growth of those earnings. In other words, Intel, from the late 1990s on, would have had to be evaluated as a franchise business with growth potential or avoided altogether by more traditional value investors. The Intel franchise, 1998 through 2017. The first step in looking at a situation like this is to understand the nature and durability of the competitive advantages/barriers to entry that protected Intel's earnings. By the late 1990s, there was little doubt that Intel, as the world's dominant microprocessor producer, was in a powerfully protected competitive position. Intel enjoyed the benefits of the most durable competitive advantage, significant economies of scale secured from erosion by strong customer captivity. Intel's customer captivity arose from the risks facing any PC manufacturer who considered building a product built with a non-Intel processor. Intel's chips were the standard around which Microsoft designed its virtually ubiquitous Windows operating systems. Alternative chips were unlikely to work as well in this software environment. Inferior microprocessor performance would degrade PC performance, which no manufacturer could risk in the highly competitive personal computer market. A new supplier could also not be counted on to deliver the large number of high-quality chips that Intel had historically always provided in a timely manner. Any disruption of high-quality chips supplied would mean costly delays in PC production. Any impairment in chip quality might permanently damage a PC manufacturer's reputation for quality products. Finally, the Intel Inside advertising campaign had raised awareness of and comfort with the value of Intel chips in the minds of PC buyers. Personal computers without the Intel Inside label risked the loss of customers, even if an Intel competitor were able reliably to supply large numbers of high-quality, high-performance chips. What this meant for competitors such as AMD and potentially IBM and the Japanese firms was that even if they were to produce a superior chip, they would, in the short term, capture only a small fraction of the microprocessor market. At the high end of the market, where Intel was dominant, new generations of microprocessors arrived roughly every 18 months. By the time a competitor's chips achieved widespread acceptance, their products would usually be obsolete. The short windows of opportunity that characterized the PC market greatly increased the difficulty of cutting into Intel's dominant market share. In deciding whether or not to invest in a new chip technology, Intel competitors could not expect to achieve sales levels that would justify the substantial R&D budgets necessary to compete with Intel's technology. And unless these companies could offer significantly cheaper or higher quality chips than Intel chips would always be the safe, preferred choice of PC manufacturers. This is where Intel's scale advantages came into play. Design of microprocessors, especially as they got faster, denser, and more energy efficient, is a large fixed cost, independent of how many units of each microprocessor get sold. The more units sold, the less the design costs per unit. Table example 4.9 shows the levels of sales, R&D spending, and operating margins for Intel and its major competitor AMD throughout the 1990s. By the late 1990s, Intel's R&D budget was 4 to 5 times as large as AMD's, even as Intel's R&D spending per dollar of sales, at about 10 cents, was less than half of AMD's, over 20 cents. Furthermore, the accounting figures for R&D represented only part of the fixed cost of bringing a new chip design successfully to market. Additional R&D type expenses were included in cost of goods sold every time a new chip fabricator line was put into operation and adjusted until chip yields, the fraction of chips suitable for sale, and chip quality met company standards. Marketing expenses were incurred to introduce the new chip and its capabilities to PC manufacturers. It is not surprising that by the late 1990s, Intel's operating margins were 4 times those of AMD. Higher costs were not AMD's or any other competitor's only disadvantage. Even at the higher R&D cost per chip apparent in table example 4.9, AMD was spending only 1/5 as much as Intel on R&D. With new generations of microprocessor chips appearing every 18 months, a large part of R&D was devoted to the development of these next-generation chips. In the race for the next generation, AMD was being outspent by a factor of 5. Under these circumstances, Intel was the inevitable winner of this repeated competition. When on occasion AMD did manage to produce a superior microprocessor, Intel quickly superseded that chip with its next-generation product. In the meantime, most PC manufacturers chose to wait for Intel, customer captivity at work, and even AMD's successful chips were never able to capture more than 30% of the market. At its existing level of sales, if AMD were to match Intel's level of R&D spending, it would typically have to spend between 50 and 100% of its revenues on R&D, a painfully uneconomic prospect. It is not surprising, therefore, that AMD was never able to make significant inroads into Intel's dominant market position. Economies of scale protected by customer captivity converted temporary competitive advantages in each generation into a permanent advantage over many generations. From the 1990s on, Intel's franchise was a powerful and durable one. The historical evidence confirms this assertion. Tables example 4.10 and example 4.13 present operating histories for Intel from 1991 to 2002 and from 2002 to 2017. Returns on equity, even without adjusting for excess cash, understated earnings due to expensed investments in growth, consistently average more than 20%. Properly measured, they have exceeded 30% for many years. Given these high returns, well-financed competitors including IBM, Japanese technology giants, and more recently, Samsung, have tried to enter the market. They have invariably failed, except at the very low end of microprocessor performance. Intel's market share, averaging 90% or better, has, if anything, grown over time. This is what a powerful, sustainable franchise looks like. The return on an Intel investment in early 1999. On March 1, 1999, when Intel's results for FY 1998 were becoming available, Intel shares traded at a price of $29.70. With 6,940 million shares outstanding, the market value of Intel was $206 billion. If we subtract Intel's net non-core liquid assets, cash plus investments minus debt of $12.1 billion, the net cost of acquiring Intel's core operating business was roughly $194 billion. Table example 4.10 presents Intel's operating history between 1991, when Intel's microprocessor franchise became clearly established, and 1998, with the years 1999 through 2002 added. Revenues in 1998 of $26.3 billion had grown at a rate of 5% over the previous year and 24.5% over the prior 5 years. Operating margins had risen steadily from 22.6% in 1991 to 39.4% in 1997, before declining to 31.9% in 1998. Over the 5 years from 1994, a year of slowing sales growth and declining margins, to 1998, Intel's average operating margin was 33.9%. Intel's average tax rate over the 5 years through 1998 was 36%, declining from 37% in 1994 to 34% in 1998 as corporate tax policy became slightly more favorable to tech companies such as Intel. Given this history, sustainable revenues in 1998 were roughly $27 billion. This accounts on the positive side for the growth in revenues over the course of the year. No downward adjustment for the possibility of future recession years seems necessary since 1998, the year of the Asia crisis, was already a slightly difficult year for Intel, and revenues still increased. The sustainable operating margin appears to be about 33%, above Intel's actual 1998 margin, but slightly below the average of the previous 5 years. Because of the generally increasing trend, a reasonable estimate of sustainable margins might have been as high as 35% above the 5-year average. In both cases, the margins appear sustainable in the face of potential competitors. Assuming fixed costs represented 20% of Intel's revenue, and Intel's sales were 2.5 times the size of its nearest competitor, both conservative assumptions given the strength of Intel's franchise in 1998, Intel would have had a fixed cost advantage of 30% over that competitor. Fixed cost of 50% of revenue for the competitor, 2.5 times 20%, compared to 20% for Intel. That would certainly support an operating margin for Intel in the 33 to 35% range. Sustainable revenues of $27 billion times a sustainable operating margin of 33% yields sustainable operating earnings for Intel of $9 billion in 1998. A reasonable sustainable tax rate is around 35%, midway between the 1998 rate and the 5-year average rate, since favorable business climates for taxes tend not to last forever. Thus, sustainable net operating profit after tax for Intel in 1998 would have been roughly $5.9 billion, 65% of $9 billion. This represents an earnings return of 3% on the cost of acquiring Intel's operating franchise at its early March 1999 market price. Cash return 1. The fraction of this return that Intel would likely distribute as cash was relatively difficult to pin down. Management had not articulated a long-term distribution policy. Historical net cash distributions to shareholders were variable until 1994. Net equity sales by Intel exceeded its relatively paltry divided distributions. More recently, net distributions as a percentage of net income had grown from 20% to 40% in 1997, before jumping to 80% in 1998. An 80% distribution level left barely enough retained earnings to support Intel's organic growth for the slow growth year of 1998. At higher organic growth rates, Intel would be unable to distribute this level out of current earnings. For this reason, a 60% distribution seems appropriate and also corresponds to the average distribution fraction over 1997 to 1998. With 60% of net income distributed to shareholders, the cash return on an Intel investment in early 1999 would have been $3.5 billion, 60% of $5.9 billion, or just 1.8%, 60% of 3%, on the investment of $194 billion. Organic growth returns. 2. For Intel, with its successive generations of new chips, organic growth is hard even to define, let alone measure, especially when compared to a stable product company like WD-40. Technically, each new generation design is a new product with its own initial market of new high-performance PCs, workstations, and servers. But for practical purposes, growth within the microprocessor industry is organic growth. The computer manufacturers, their main customers, and even users of computing power in non-traditional applications such as automobile controls, historically have constituted a reasonably stable population. The design and production challenges have also had a high degree of continuity, so that the supply side of the market also was served by a relatively stable group of firms, primarily Intel. Organic growth in this arena of all microprocessor and microprocessor applications has not been entirely driven by external economic factors, such as economic growth and technology. For example, Intel has always sought out new applications for an extension of its chip technology. But like organic growth, this process was largely a continuous one that was not the subject of large capital allocation decisions. The vast majority of the investment involved, R&D and marketing, was expensed for accounting purposes and independent of explicit allocation decisions related to retained earnings. By this definition, Intel's growth from the late 1980s through the end of 1998 was almost entirely organic growth. During that time, Intel made no significant acquisitions. Flash memories, its major product extension outside of microprocessor and related chipsets, had by the end of 1998 produced very limited sales and no profits. Yet even with this broader definition of organic growth, it was still difficult to forecast. Actual growth in revenue and operating earnings from 1991 to 1998 averaged 28% and 34% respectively. Management's announced growth targets, generally in the range of 20% or more, reflected this experience. For the very long term, these growth rates were not going to be sustainable, despite Intel's observable performance. For analysts, one way out of this difficulty is to define a high-growth period of fixed duration, and then a subsequent future of much lower stable long-term growth. For some companies, such a strategy might work well. As an example, Google is a company whose technology replaces the operation of a well-defined existing market segment, information advertising. A target level for Google's mature sales can be estimated by adding current information advertising revenues spent in various media on a global basis excluding China, where Google is not dominant. These consist of yellow pages, newspaper classified ads, business directories, focused consumer publications, some direct mail, and so on. They have historically grown about 1% faster than global GDP. The next steps are to estimate how much of this revenue will move to the web, at least 80%, and about what market share Google might capture, say 50%. Those calculations yield a mature revenue level for Google. The length of Google's high growth period could then be calculated as the time it would take to reach this mature level of revenue at a high growth rate, extrapolated from Google's historical experience. Beyond that point, the growth of Google's revenues would be predicted to decline to 1% above global GDP. Unfortunately, there is no such well-defined revenue that Intel will displace. Information technology in all its forms is in the process of remaking the whole of industrial society. For Intel, the only realistic alternative is to assume a long-term organic growth rate that A, generates a finite value for Intel future earnings, and B, embodies a level of growth above that of global GDP. How far above that figure is difficult to say, but in the history of the modern industrial economy, no industry has grown faster than 3% of GDP for more than 50 years. Thus, a reasonably long-term organic growth rate for Intel would be 3% above the growth rate of global GDP. In 1999, global GDP was forecast to grow at 5 to 6% in nominal terms. If we add 3% to this figure, we get an organic revenue growth rate for Intel going forward of 8.5%. Intel's operating profit margin was essentially stable from 1993 to 1998, so operating earnings and net operating profit after tax were likely to grow at the same 8.5% rate as revenues. Thus, organic growth should, as a first guess, contribute 8.5% to investor returns. Active investment returns 3. The amount of investment necessary to support organic growth naturally depends upon the rate of growth. The 20% growth, roughly Intel's 1990s average, would have added $5.4 billion in the first year to Intel's revenue from our estimated sustainable revenue level of $27 billion. The amount of fixed capital required per dollar of revenue averaged 45% from 1991 to 1998, with a downward trend in the early years and an upward trend more recently. Use of the average 45% figure yields an investment level of $2.43 billion to support 20% organic growth. A 40% earnings retention level in 1998 would provide $2.34 billion out of $5.05 billion sustainable earnings, leaving nothing for active investment. At our lower long-term organic growth rate of 8.5%, the investment required to support organic growth would have been $1 billion, 45% of $3.2 billion in incremental revenue. Subtracting the lower-level organic growth investment from retained earnings would have left about $1.3 billion for active investment. During the 1990s, Intel was highly disciplined in its focus on its core microprocessor business. In the 5 years from 1993 through 1997, Intel made no acquisitions. In 1998, Intel paid $321 million for Chips and Technologies, a maker of graphic products that Intel hoped would enhance the graphics capability of its chipsets. It paid another $585 million for the semiconductor operations of digital equipment, including $475 million in capital assets and some mobile microprocessor technology. On December 31, 1998, Intel had no significant goodwill on its balance sheet. For investments classified as current expense, flash memory was the only non-core product developed. This activity formed part of Intel's Computer Enhancement Group, CEG, which consisted mostly of chipsets and products to install microprocessors in non-computer environments. In 1998, CEG, of which Chips and Technologies was a part, reported operating earnings of $358 million on sales of $4 billion compared to earnings of $9.1 billion on sales of $21.5 billion in the core microprocessor business. Essentially, all of CEG's profits were due to natural extensions of the core microprocessor business that we treated as organic growth. To the limited extent that Intel actively invested for growth outside its organic franchise, the return appears to have been negligible. Any expensed investments, therefore, were either oriented toward organic growth, in which its return was included, or they were devoted to new initiatives for which returns appear to have been zero. From 1996 to 1998, despite CEG revenues that increased from $3.6 billion to $4 billion, CEG operating earnings fell from $940 million in 1996 to $529 million in 1977 and $358 million in 1998. Under these circumstances, we do not need to add back our former 25% of R&D and SG&A to operating earnings and then trace its impact through active reinvestment. The impact was nil. Generally, retained earnings by Intel did not go to new initiatives. They went to cash and outside investments. From year-end 1994 to 1998, Intel's net cash plus investment position increased from $3.7 billion to $12.1 billion. The value of these investments depends on how long the cash stays in the company and where it goes when it gets spent. While it is in the company, its value to the investor is reduced by 35% of the amount earned on the cash due to the double taxation of returns, once at the corporate level when they are earned, and again at the individual level when they get distributed. Without compelling investment opportunities, the best final outcome is that the funds get distributed to investors, the sooner the better. If they are distributed within 5 years, the loss in value on the amount earned may be as little as 10%. If they are ultimately invested in unrelated initiatives as Intel's core business deteriorates, a common practice of managements trying to maintain growth, the value destruction may be total. Toward the end of 1998, Intel announced 2 relatively large acquisitions in non-core communications technologies, as well as new priorities in this direction. Thus, by early 1999, the second path for cash use had become a far more likely outcome. In the long run, as organic growth slowed, this tendency could only get worse. Taking that probability into effect, we will reduce the value of additions to cash by 50%. Our $1.3 billion of notional active reinvestment should therefore add $650 million in active investment returns to our overall return, which represents about an additional return of 0.3%. Total return, Intel's cost of capital, and Intel as a value investment. These calculations are summarized in Table Example 4.11. The total return estimated for an investment in Intel in March 1999 was 10.6%, consisting of 1.8% cash return, 8.5% from organic growth, and 0.3% from active investment. Intel's cost of capital, which we estimated at 12% for the late 1980s, should also be the likely cost of capital in 1998. An investment in Intel stock, even after its dominant position in microprocessors had been established, remained a highly risky one. The great majority of the return embodied in the 8.5% organic growth lay in a distant, uncertain future. Moreover, unlike the risk associated with WD-40, Intel's risk should be largely undiversifiable, since future growth in Intel's earnings would critically depend on future growth in the global economy as a whole. Overall, therefore, Intel was an investment likely to earn a below cost of capital return. It certainly provided no margin of safety to protect against franchise fade. By early 1999, Intel's franchise position in microprocessors had a duration of 10 to 12 years, much shorter than that exhibited by WD-40. Its industry was experiencing rapid change, and there were already indications that parts of the Intel franchise were subject to serious competition. In the portion of the microprocessor market for lower power devices, such as smartphones, originally personal digital assistants with the phone feature added later, notebook computers, and laptops, R&D costs were much less. Entrants could therefore be viable at much lower market shares. Also, low-end devices tended to use older, more seasoned technology, reducing customer captivity. By the end of 1998, companies such as AMD had established sustainable competitive positions in the low end of the market. If this portion came to occupy more of the overall microprocessor market, as the value of incremental technological performance became subject to the law of diminishing returns, Intel's competitive position could erode rapidly. Under these circumstances, the assumption that Intel's franchise had no more than 20 to 30 years of remaining life would not have been extreme. Lives of this length correspond to the franchise fade rates of 2.5% to 3.5% per year. If we were to subtract these fade rates from our estimated return of 10.5%, the net return offered by the Intel investment would fall to between 7 and 8%, well below Intel's cost of capital. Franchise fade rates were a serious negative factor for an Intel investment in early 1999. Matters were even worse than this. The organic growth rate applies to the intrinsic value of Intel, not to its inflated market value. To calculate a true return to organic growth, we must multiply the contribution of organic growth rate by the ratio of intrinsic value to market value. As we derived in Chapter 8 on growth valuation, the ratio of intrinsic value to market value should approximately equal the ratio of the estimated future return to the cost of capital. If we assume that all-in estimated return includes an average fade rate of 3%, then the estimated return for Intel will be 7.5%. This is just 62.5% of our 12% cost of capital. If we multiply the organic growth rate of 8.5% by 62.5%, we get a true/adjusted organic growth return of about 5.5%. This further 3% point reduction in our estimated return gives us an adjusted Intel return estimate of just 4.5%, a very poor return indeed compared to Intel's 12% cost of capital. Intel in March 1999 was not a good value investment, however attractive its near to intermediate term prospects looked. As it turned out, Intel's franchise did not wholly evaporate over the next 15 years, but its growth rate fell more than we projected. Nevertheless, our 4.5% estimated return would have significantly overestimated subsequent performance. Table example 4.12 presents 5, 10, and 15-year returns for Intel stock going forward from March 1st, 1999. The annualized returns were respectively 0.6%, minus 7.3% in 2009 at the trough of the financial crisis, and 0.7% for the 15 years starting in March 2003 and ending in February 2018. Even our pessimistic estimate of Intel returns proved insufficiently negative. Investing in bubble stocks under bubble conditions is a practice value investors, and everyone else, are well advised to avoid. Intel in March 2003. From a price of $29.70 on March 1st, 1999, Intel stock price rose to a peak of $74.88 in late August 2000 before bottoming out at $13.42 in early October of that year. By March 3rd, 2003, the price per share had recovered to $16.66. At that point, Intel might have been a reasonable candidate for a value investment. The company's stock market performance had been spectacularly disappointing. Its price-to-earnings ratio was still high at 35 times, and its market-to-book ratio of slightly over 3 provided little asset protection. However, a case could be made that 2002 earnings were cyclically depressed, so that sustainable earnings of $1 per share were a more reasonable basis for estimating earnings power. This would have produced a price-to-earnings ratio of 16 or 17 to 1 for a company with a powerful franchise in an industry with good long-term growth prospects. Through the end of 2002, the last year for which data would have been available in March 2003, no significant impairment of Intel's barriers to entry/competitive advantages had taken place. Its long-term growth prospects, looking forward from 2000, had deteriorated only slightly. From 1998 to 2002, Intel's business performance mirrored the roller coaster ride of its stock price. Sales rose from $26.3 billion in 1998 to $33.7 billion in 2000, before falling back to $26.8 billion in 2002. Operating margins went from 31.9% in 1998 to a high of 33.2% in 1999, then to just 8.2% in 2001, before recovering to 15.7% in 2002. The critical question concerning an Intel investment was whether these lower levels of earnings, revenue, and revenue growth were permanent or temporary. On the positive side, Intel continued to dominate the microprocessor market with a share of over 90%. Its reputation for quality and its technical preeminence were unimpaired. Microprocessors, despite the bursting of the telecom bubble in early 2000, remained at the heart of developments in computing power that were generating innovations in automation, graphics interfaces, data handling, internet communications, remote computing, and technical analysis. These innovations were still the engine of growth in the early 21st century economy. Reasonable estimates of both sustainable earnings and sustainable long-run growth would have been below those of March 1999, but not massively so. Adjustments for the artificial break in demand in 2000 and the cyclical developments of 2001 and 2002 suggest a sustainable revenue of $30 billion. This estimate embodies an annual revenue growth rate of only 2.5% between 1998 and 2002. Since potential microprocessor sales were almost certainly growing at least as rapidly as GDP as a whole, perhaps 4 to 5% per year in nominal terms in the early 2000s, this figure would have allowed for some increase in our earlier sustainable revenue estimate of $27 billion. Operating margins did appear to be in a long, slow decline since the mid-1990s as technological demands raised costs, but Intel's dominant position and pricing power should have limited this decline going forward. An estimated sustainable margin of 25% for 2002 would have represented both a significant decline from our 1998 estimate of 33%, in line with more recent experience, but at a level significantly above the depressed results of margins in 2001 and 2002. Sustainable operating earnings would then have been estimated at $7.5 billion. Intel's average tax rate from 1998 through 2002 was 33%, which appears consistent with likely future developments in global, U.S. federal, and state and local corporate income tax policy at the time. Applying this tax rate would have meant an estimated level in 2002 of $5 billion in net operating profit after taxes. On a year-by-year basis, distribution to shareholders from 1999 through 2002 averaged 128% per year. This figure is inflated by the maintenance of a preset policy of dividends and buybacks despite declining earnings, which included a serious trough in 2001. If instead of taking the average percentages of annual distributions, we divide total distribution for 1999 through 2002 by total net income for those years, we get a distribution percentage of 70%, which is far more reasonable than the average annual percentage. Still, Intel's net cash position fell from $18.5 billion at the end of 1999 to $12.5 billion at the end of 2002. a continued distribution level of nearly all earnings was unlikely to have been sustainable in the long term. At the same time, as we will discuss in more detail later, Intel had begun to diversify its business activities, a move that would require significant capital, both for acquisitions and to finance internal developments. Thus, we will assume that distribution policy from 2002 going forward would have been captured by our earlier estimate of 60%. This yields a sustainable cash distribution of $3 billion per year. At a price of $16.66 per share, Intel's market value would have been about $112 billion, down substantially from $206 million in March 1999. From this figure, we must subtract Intel's cash and investment holdings, net of debt, of slightly over $12 billion at the end of December 2002, to obtain the $100 billion market cost of acquiring Intel's core franchise business on March 1, 2003. At this cost, the $3 billion of sustainable annual cash distribution represented a 3% annual cash return, well above the 1.8% figure of March 1999. These estimates are summarized in Table Example 4.11. It is worth noting that calculation of the impact of varying revenue, operating margins, tax rates, and distribution policy assumptions in this context is simple and straightforward. Organic growth in March 2003. In the 5 years, 1992 through 1996, growth averaged 34%. In the 6 years, 1997 through 2002, growth dropped to just over 4% per year. From 1999 through 2002, it was reduced to 0.5% per year. Clearly, by 2002, the years of extraordinarily rapid growth in Intel's core market were over. On the other hand, given the critical role of microprocessors in advanced technology sectors, extrapolation of the recent experience of 2002 with organic growth rates below the rate of global GDP growth would have been overly pessimistic. Global GDP growth looking forward from 2002 appeared to be about 3 to 3.5% in real terms, with 1 to 1.5% inflation. That came to 4 to 5% per year in nominal terms. This is slightly below the 5 to 6% global growth rate we forecast in 1999. The rate of growth of productivity among the world's developed economies, and with that the overall rate of economic growth, had clearly slowed by the early 2000s. This decline was partially offset by the greater weight of rapidly growing economies such as China and India on total global economic activity. A reasonable assumption would have been that Intel's core market would grow at or near this rate. We will estimate Intel's future organic growth from March 2003 at 4 to 5%. We assume that the long-term decline in Intel's margins would stabilize at 25%. Earnings growth, and therefore value growth, should occur at the same organic growth rate as revenues, 4 to 5%. Active investment returns. At this growth rate, Intel's sustainable revenues from 2000 to 2003 would have grown by $1.35 billion per year. The investment necessary to support each dollar of this growth appears not to have changed significantly since 1998. Net fixed capital in 2002 was roughly the same 45% of revenues as in 1998. Net working capital remained near zero. At this level of investment, the projected $1.35 billion in organic revenue growth would have required $0.6 billion, 45% of $1.35 billion of reinvested earnings. With our sustainable net operating profit after tax of $5 billion, distributing $3 billion to shareholders leaves $2 billion of retained earnings. After spending $0.6 million in support of organic growth, $1.4 billion would have been available for active investment. Looking at the value created per dollar of this active reinvestment, the results between 1998 and 2002 were hardly encouraging. In 1999, Intel spent more than $5 billion, largely on communications-related acquisitions. In 2000, it spent $2.3 billion, followed by $0.9 billion in 2001. Fortunately, there were no further significant acquisitions in 2002, but Intel continued to prospect in areas outside its microprocessor core business. The returns to these efforts were dismal. From 2000 through 2002, Intel's non-core operations, its wireless communications and computing group, and its communications group, had revenues of $15.3 billion and a net operating loss of $0.7 billion. Investment on acquisitions alone had been more than $8 billion. The value creation appears to have been zero. At best, if we discount the 2001 and 2002 years as cyclically depressed and unrepresentative, the after-tax net operating profits in 2000 was $0.6 billion. This represents a 7.5% return on the $8 billion in acquisition-related expenses. With the cost of capital on these new, relatively unfamiliar initiatives likely to be at least 12%, the value created per dollar was about 60 cents, 7.5% divided by 12%, making the value creation factor on actively reinvested earnings 60% at best. We will use a factor of 50%. At this level of return, the $1.4 billion in active reinvestment would have created $0.7 billion in value, which was 0.7% of the $100 billion cost of Intel's core enterprise. This figure can be found in Table Example 4.11. Aggregate returns, the cost of capital, and fade rate. The total estimated return to an Intel investment in early March 2003 would have been 8.2%, consisting of a cash return of 3%, organic growth of 4.5%, and an active reinvestment return of 0.7%. Intel's cost of capital in March 2003 would have been lower than its cost in March 1999, since microprocessor market conditions had stabilized and less of the overall return was embedded in growth, and thus in the far distant future. On the other hand, events since 1999 had demonstrated that future growth rates were highly uncertain and that Intel's results were more cyclically sensitive than anticipated. There was also significant uncertainty about the future direction of margins, which would depend on the development of the microprocessor industry, and in turn, on the growth of the overall global economy. Under these circumstances, a cost of capital of 11% does not seem unreasonable. Between 1999 and 2003, Intel's franchise had clearly not disappeared, but the probability of future fade remained. Intel itself was concerned that the incremental benefits of greater microprocessor power would diminish over time as basic computers became more and more capable. If this were to occur, then developments at the low-performance end of the microprocessor market, where Intel already experienced substantial competition, would spread to the market as a whole. The consequences of these changes were beginning to be apparent in the mobile computer market. For mobile devices, communications bandwidth, not local computing power, was the limiting factor. Thus, the demand for high-performance microprocessors was significantly lower in the mobile market than in the basic IT computing market. ARM, the leading microprocessor design firm in the mobile market, had only a fraction of Intel's profitability and market value. The fade rate of 2.4%, a 30-year half-life that we used in 1999, should continue to be applicable in 2003. For Intel in 2003 to be a genuine value investment, the estimated return of 8.2% would have had to exceed the cost of capital at 11% by a margin of safety at least equal to the fade rate of 2.4%. Instead, Intel offered a return below its cost of capital. Changing growth prospects, management behavior, and the original overvaluation in 1999 meant that even after a price decline of roughly 45%, Intel in 2003 remained an unattractive investment. These figures are summarized in table example 4.11. Moreover, our initial return estimate in 2003, like the estimate in 1999, was overly optimistic. The return formula applied the organic growth rate to the market value of Intel, not as it should, to the intrinsic value. In March 2003, the post-fade return to an Intel investment was 5.8%, roughly half the cost of capital of 11%. The ratio of estimated return to the cost of capital should approximate the ratio of intrinsic to market value. The return ratio is 53%, 5.8 divided by 11. If intrinsic value were therefore just 53% of Intel's market value, then the true value of Intel's organic growth was just 53% of the organic growth rate of 4.5%, or 2.4%. The reduction in future returns is 2.1%, 4.5% minus 2.4%, which yields an estimated future return, looking forward from March 1st, 2003, of just 6.1%. This made Intel, at that time, an unattractive investment. In this instance, our estimated return tracked actual future Intel returns relatively well. Intel's franchise did not evaporate over the next 15 years, so that the appropriate comparison is to our estimated pre-fade rate of return of 6.1%. Actual average annual returns for the 5 years from March 2003 to March 2008 were 5.6%. Despite higher than market risk, Intel underperformed the S&P index by 5.6% per year. In the 10 years from March 2003 to March 2013, average realized annual returns were 5.1%, again, underperforming the S&P. Both returns are reasonably close to our 6.1% estimate. However, from 2015 to 2018, Intel stock performed exceptionally well. In the 15 years post-March 2003, the return was 10.2%, underperforming the S&P 500 by only 0.1% per year. The next and final question we address is whether the stock market returns that underlay this 15-year performance related to actual business developments that we should have anticipated, or to the kind of chronic overvaluation that, since the 1990s, boosted Intel's stock. Intel in March 2018. Between 2002 and 2017, Intel's business continued to evolve. The low end of the microprocessor market for tablets and smartphones became unprofitable for the company. For these relatively low-performance devices, Intel's advanced technology provided no advantage. However, Intel managed to dominate the increasingly important market for server microprocessors, where high performance was crucial. It also continued to enjoy a strong franchise portion in the market for high-performance desktop PC microprocessors. Other initiatives in vision systems, programmable microprocessors, computer security, and communications have been less successful. By 2017, Intel had distinct operations in two major business segments for PCs, the Client Computing Group, and servers, the Data Center Group, and three smaller segments for processors embedded in a wide range of smart equipment, such as driverless cars, the Internet of Things Group, for programmable processors, the Programmable Solutions Group, and for non-volatile memories. The final results of this evolution are presented in table example 4.13. From 2002 to 2017, Intel revenues had grown by nearly 6% per year. Operating margins had risen from 16% in 2002 to a peak of nearly 36% in 2010, before declining to just under 29% in 2017. The price of an Intel share rose from $16.66 in early March 2002 to $47.84 in early March 2017. As a result, the enterprise value of Intel's core business grew from $100 billion to $232 billion. The question for investors was whether the improved performance of Intel's core business justified the substantial increase in market value. Intel's cash return. By the end of 2017, Intel's revenues were running at a rate of roughly $64 billion per year. That year was a relatively good one for Intel, but not a cyclical peak. A sustainable revenue estimate of $64 billion in March 2018 seems appropriate, although perhaps slightly generous. Intel's average operating margins over the 5 years up to and including 2017 were 25%. Over the 10 years to 2017, operating margins averaged 26%, as they had for the 15-year period. They were remarkably stable, although with a small but persistent downward trend. We will assume that sustainable operating margins for Intel at the end of 2017 were 25%. This figure yields an estimate of sustainable operating earnings of $16 billion, 25% of $64 billion. Corporate income tax rates for Intel in the 5 years from 2012 to 2016 averaged 23%. In 2017, Intel's reported tax rate was an unusually high 53% due to the one-year effect of the 2017 U.S. Tax Reform Act and the repatriation of accumulated earnings held offshore. Ultimately, the 2017 legislation would lower, not raise, taxes for Intel. But as less business-friendly governments come to power, faced with demographic needs for higher retirement and medical expenses, these lower rates might not survive. After adjusting for the temporary effect of the tax reform and the one-time sale of the Intel Security Group, Intel itself estimated that its 2017 tax rate would have been 23%. We will use that figure as our estimate of Intel's long-term tax rate. The estimated sustainable net operating profit after tax is then $12.3 billion, 77% of $16 billion. Intel's historical cash distribution levels out of net income were high and relatively stable over 5-year periods. From 2003 through 2007, Intel distributed 91% of its reported net income in dividends and net share buybacks. From 2008 through 2012, the distribution fraction was 92%. From 2013 through 2017, it fell to 73%. There appear to have been 2 reasons for this decline. First, Intel's core business became more capital-intensive over time. In the early 1990s, the balance sheet value of property, plant, and equipment was about 45% of annual revenue. By 2013, this ratio had increased to 60%. In 2017, it was 65%. The rise in capital intensity increased the amount of investment necessary to support organic growth, leaving fewer funds available for distribution to shareholders. This squeeze was exacerbated by extensive investments in areas beyond Intel's core business as management sought to diversify its operations. Second, by 2017, Intel's habitual positive net cash balance, cash and investments minus debt, had evaporated. The net cash of $14.4 billion at the end of 2013 had turned into a negative $3.9 billion at the end of 2017. Continuing to distribute 90% or more of net income would require further borrowing and debt accumulation, a financial strategy that did not seem to appeal to Intel's management. For these reasons, we will assume a cash distribution level of 80% of net income, above the 2013 through 2017 average, but below the long-term historical norms. This level yields a sustainable annual cash return of $9.9 billion, 80% of $12.3 billion. If anything, this is a generous estimate. Future distribution levels below the 73% level of 2017 appear to be far more likely than a return to the historical levels of 90%. The $9.9 billion of sustainable cash distribution represents a 4.3% return on Intel's March 2018 enterprise value of $232 billion, higher than the March 2003 cash return of 3% and well above the 1.8% estimated cash return in March 1999. Organic growth return. For the 6 years between 2012 and 2017, peak to peak, Intel's revenues grew by 2.5% per year. From 2005 to 2017, again peak to peak, revenues grew at 4.1% per year. Recent average historical revenue growth appears to have been about 4% per year, at or slightly below global GDP growth. Going forward from 2017, the slowdown in productivity and labor force growth in China, coupled with continued slow growth in the developed economies, meant that future real global GDP growth would be about 3% per year. With roughly 1.5% annual inflation, this puts nominal global GDP growth rate at 4.5%, slightly below the nominal global growth rate for the years during which Intel's revenue growth averaged almost 4%. Therefore, organic revenue growth for Intel going forward from 2017 should be about 4%. Earnings growth, given the slow historical margin deterioration, should be slightly below this figure. To be optimistic, we will estimate organic growth in value for Intel at 4% per year, slightly below our March 2003 estimate of 4.5%. Active investment returns. With 4% organic growth in revenue, Intel's 2018 revenues should increase by $2.6 billion, 4% of $64 billion. The investment necessary to support this growth at recent fixed capital levels of 62.5% of revenue would be about $1.6 billion. Required working capital investment should be essentially zero, which has been the historical experience. Retained earnings at 20%, 100% less than 80% payout ratio of $12.3 billion in sustainable earnings would be $2.5 billion, leaving $0.9 million for an active investment after the $1.6 billion necessary to fund organic growth. In fact, Intel had been investing far more than this amount in new initiatives. Spending on acquisitions averaged $6 billion per year from 2011 to 2017. The largest purchases were Altera, a maker of programmable semiconductor chips, for $14.5 billion in 2015, and Mobileye, a computer vision, data analysis, machine learning, and self-driving car company, for another $14.5 billion in 2017. The value created by these investments was highly questionable. In 2011, Intel acquired McAfee, a computer security software company, for $7.7 billion. In 2017, Intel sold a majority stake in its Intel Security Group at a valuation of $4.2 billion. In the interim, the after-tax earnings of the group appear to have averaged no more than $150 million per year. Assuming that the cost of capital associated with the McAfee acquisition was 10%, the value Intel received for its $7.7 billion investment amounted to just 50 cents per dollar invested. The Altera acquisition looks equally disappointing. In the 5 years from 2010 through 2014, the last year for which Altera published independent annual financials, Altera reported operating income that declined from $868 million to $553 million. Revenues over that 5-year period were essentially flat, falling from $1.95 billion in 2010 to $1.93 billion in 2014. Intel's Programmable Solutions Group appears for the first time in 2016 annual report. Most of Altera's operations would have fallen within this segment. The group's reported revenues were $1.67 billion in 2016 and $1.9 billion in 2017. Operating income was negative $104 million in 2016 and positive $458 million in 2017. If we were to assume, generously, that Intel's incremental operating income from the Altera acquisition was level at $600 million per year, then the return on its Altera investment would have been 4.1% per year, $0.6 billion divided by $14.5 billion. Assuming a cost of capital of 10%, this represents roughly 40 cents of value created for each dollar invested. The Mobileye acquisition also appears to have been a mistake. In its last year as an independent company, Mobileye had revenues of $358 million, 660 employees, and an operating income of $120 million. The company may have had valuable technology, but it was operating in fields where technology was changing rapidly, and neither it nor any of its many competitors had established a dominant position. Under these circumstances, current earnings power/asset value was what Mobileye was likely to be worth. Since asset value was difficult to assess, earnings power value is our best measure of what Intel got for its $14.5 billion. Assuming a 20% tax rate and 10% cost of capital, Mobileye's earnings power value would have been about $1 billion, $120 million times 80% divided by 10%, a mere 7% of the price Intel paid. This looks like another example of value destruction brought about through Intel's active investment practice. Given this history, a value creation factor of 40%, 40 cents per dollar, for Intel's active investments would be optimistic. We will estimate the value creation factor at 1/3. If Intel were simply investing the $0.9 billion out of its retained earnings after financing organic growth, the net value creation would be $0.3 billion, $0.9 billion times 1/3, an additional return of roughly 0.1%, $0.3 billion divided by $232 billion to the company's results. But if Intel were to devote even $2 billion per year to this kind of active investment, far less than the $6 billion per year recent average, then ultimately $1.1 billion would have to come from reduced shareholder payouts, $2 billion less, $0.9 billion. In this case, the net return would be negative $0.7 billion, 2/3 value destruction per dollar times the $1.1 billion reduction in cash distributions. This figure would represent negative 0.3% of Intel's $232 billion enterprise value. Rather than assume that such behavior would persist, given Intel's overall history of good management, we will simply assign a 0 value to Intel's active investment return. Total return, cost of capital, and fade rate. Our total return estimate for Intel is 8.2%, composed of the cash return of 4.2% plus organic growth of 4%. The cost of capital against which this return should be measured would have been less than the cost of capital in 2003 for three reasons. First, interest rates in early 2018 were lower than those of 2003. The March 2018 yield on a 20-year U.S. Treasury bond was 3.1% compared to 4.1% in 2003. Second, given the increase in the cash return between 2003 and 2018, a smaller fraction of the return from 2018 would have depended on future growth and returns in the distant future. Third, the greater historical stability and longer track record for Intel in 2018 compared with 2003 would have reduced the uncertainty of an Intel investment. On the other hand, Intel remained a relatively risky investment that should have warranted an above-market average return. With required venture capital returns in 2018 at around 13% and the overall stock market yielding around 7%, a 10% cost of capital midway between these two figures seems appropriate. This is 1% below our 2003 cost of capital estimates. But even at a lower 9% cost of capital, Intel's roughly 8% return would have provided no margin of safety against franchise fade, and in 2018, fade risk remained a significant concern for Intel investors. Regarding the fade rate, some good news and some bad news had emerged in the years since 2003. The good news was that a large part of Intel's franchise remained intact. This was especially the case in the relatively rapidly growing server market, driven by cloud computing, that Intel had succeeded in dominating. Also, Intel continued to lead the microprocessor market for desktop PCs. By early 2018, Intel had maintained its leading position in the greater part of the microprocessor market for 25 to 30 years. The bad news was the evidence from the mobile segment of the markets, especially smartphones and tablets, that demonstrated just how rapidly Intel's franchise position might disappear. By 2012, Intel's mobility segment, making microprocessors for smartphones and tablets, was down to $1.8 billion in revenue, with operating losses of $1.8 billion. 2 years later, revenues had dropped to $0.2 billion, while operating losses had risen to $4.2 billion. In 2017, Intel's Client Computing Group, which made microprocessors for PCs, including the old mobility products, had revenues of $34 billion, stable since 2014, but with income of only $12.9 billion, down from $14.6 billion in 2014. If the desktop market represented by the Client Computing Group followed the mobility market, then Intel as a whole would be in genuine trouble. Balancing these two factors, the optimistic approach would be to assume that the expected future half-life of Intel's franchise had grown slightly, say from 30 to 40 years. This would mean a reduction in fade rate from 2.4% to 1.8% per year. The post-fade return to Intel stock in March 2018 would then have been 6.4%, 8.2% minus 1.8%. Compared to a cost of capital of roughly 10%, this would correspond to an intrinsic value to market value ratio of roughly 2/3. Adjustment of the organic growth return to reflect this factor would lead to a further reduction in our estimated return of 1.3%, 1/3 of 4%. Thus, our adjusted pre-fade return estimate would be 6.9%, 8.2% minus 1.3%. Including the fade rate, the return would be just 5.1%. Intel stock in March 2018 was not a bargain and was almost certainly significantly overvalued from a long-term perspective. This ought not to surprise us. From March 2014 to March 2018, Intel's stock price almost doubled. Its average return over the period was roughly 22% per year. At the end of such a run, it was not the kind of disappointing, cheap, ugly stock that is representative of most value opportunities. Even assuming a sustainable franchise and decent prospects for growth, the initial starting price relative to intrinsic value posed a major challenge to a successful investment in Intel. Conclusion: Intel stock has experienced dramatic changes in price over the last 30 years. There have been dramatic declines, such as that between 1998 and 2002, and rapid rises in response to improved operating performance, such as the period between 2014 and 2018. But price movements by themselves have not determined whether Intel is a worthwhile value investment. Value for a franchise business such as Intel depends not just on current earnings, but also on future organic growth prospects, the quality of capital allocation, and the likelihood of franchise erosion. Balancing the impact of these complex forces on valuation can be effectively done only in the context of a return-based approach of the kind we have used here. DCF valuations capturing all these factors would be unavoidably opaque and imprecise. 9. Research strategy. A third step in the investment process after search and valuation is the active and intensive collection of information. When Benjamin Graham and David Dodd did their seminal work, many investors did not even perform detailed analyses of company financial statements. Indeed, until the Securities Act of 1933, even companies with publicly issued securities were not required to publish systematic financial information on a regular basis. Active research at the time consisted largely of ferreting out the information necessary to perform a basic valuation. For example, one of Graham's key insights into railroad valuation was that detailed financial statements and operating information, although not widely published, had to be filed with the Interstate Commerce Commission, the federal body responsible for regulating railroads, where they could be inspected by the public. Today, basic financial and operating information for all companies is instantly available to all investors on the Internet. The SEC itself publishes corporate filings, including quarterly 10-Qs and annual 10-Ks on its EDGAR website. Services such as Bloomberg and Capital IQ facilitate use of this information by organizing data from many sources and compiling them into standard electronic formats for either quick viewing or further analysis. Modern investors look well beyond the basic data that underlies valuation. Still, even with this instantaneous availability, much important information is overlooked, and a good deal of effort goes into collecting information of only peripheral value. A systematic research strategy is an important part of any well-conceived investment process, especially since so much information is readily available to investors on the other side of the trade. By research strategy, we refer to the effort spent actively investigating investment opportunities after a basic valuation has been done. A good research strategy will be both complete and efficient. By complete, we mean that it should cover all the important information, both specific to the company and more general, that bears on the likely success of the investment. In particular, it should address all of the collateral evidence that is readily available and often overlooked. Careful analysts should always know who owns or has recently sold a security in which they are interested, whether management is buying or selling the company's stock, how prevailing market opinion views the company and its prospects, and how well or badly the analyst him or herself has done with past investments in similar opportunities, and what was learned in the process. By efficient, we mean that an analyst's efforts should be focused on the information that is likely to have the greatest impact on valuation. This means identifying the key assumptions that underlie a valuation and concentrating research time on them. This last point may seem obvious, but many investment firms have research practices and information collection formats that must be followed, regardless of their relevance to a particular investment decision. Indirect information. Collection of indirect information begins by looking at who owns the stock of a company. This information is regularly published both in the United States and in other major markets. One source is the company itself, which usually publishes the identities of major shareholders. A second source is information on the holdings of major financial investors. In the United States, investors managing more than $100 million in U.S. equities must reveal their equity holdings on a quarterly basis to the SEC. In addition, when a particular investor acquires more than a threshold percentage of a company's stock, that fact must often be disclosed in a separate regulatory filing, both in the United States and abroad. This information is generally available from all the major financial data services, as well as the SEC's EDGAR. For the holdings of particular investors, there are websites that are devoted to publicizing them, especially the subgroup of investors deemed especially worth following, usually investors who have a history of outstanding performance. But a note of caution is in order. The information may not be up to date, and the prestigious investor may be mistaken. The fact that some notable investor owns the security is something to be noted, not blindly followed. One obvious way to use this information is as part of a search strategy. Seeing what successful investors such as Warren Buffett currently hold and have recently bought, and then following their actions is not a bad way to invest. If the stocks in question have declined since the most recent disclosure, so that an analyst can get a better price than an outstanding investor, then buying later may even enhance returns. In pursuing this strategy, it helps to identify those areas in which noted investors have been most successful. By virtually everyone's judgment, Warren Buffett is an outstanding investor, but he has done especially well investing in banks and insurance companies. He is a long-term student of both industries and has owned and run companies in them. His other selections, while successful, have not done as well. As another example of specialization, Mario Gabelli has been a successful student of the media and telecommunications for decades. If you are going to look to noted investors for ideas, concentrate on those areas in which they are most expert and/or have been most successful. The benefits of identifying expertise apply to geography as well as industry. Suppose you decide to look at potential investments in Turkey because it has experienced a major market decline and is the source of a raft of bad economic and political news. The holdings and recent purchases of investors who have long-term experience and a record of successful investments in Turkey will be a good place to start. In looking at industries or regions that are not within your own circle of competence, developing a list of well-informed, successful investors and examining their holdings is potentially useful. A second benefit of looking at who owns a particular security arises after you have done an initial valuation. If the company in question is widely held by disciplined, value-oriented investors with high levels of relevant expertise, that is obviously a positive sign. If they have been increasing their holdings in the face of a declining stock price, that is an even stronger one. It indicates that they were comfortable with their initial positive assessment and willing to take advantage of the decline in price to increase the number of shares they own, if not always the dollar size of the position. On the other hand, if those same investors are reducing their holdings in the face of declining prices, you ought to be cautious and review carefully your valuation assumptions. If the shareholders of your target security have been historically less disciplined, less well-informed about the area, and less successful investors, then again you want to consider, but not necessarily abandon, any originally favorable view. One set of investors who are particularly well-informed about a company's future prospects are the company's senior managers and directors, the classic insiders. Whenever they buy or sell company securities, they are required to disclose their actions, including the nature, timing, and size of any transaction. This information is then almost instantly disseminated over the Internet by the SEC and financial investment information services. Insider behavior has historically been a powerful predictor of the likely success of an investment. If they are buying, the chances are good that they believe the stock is undervalued and will appreciate in price. Sometimes insiders make arrangements to sell when a stock price reaches certain pre-specified levels. These levels are sometimes disclosed and sometimes can be inferred from repeated transactions. Higher pre-specified selling prices clearly represent a more positive view of the company's future. Just as the holdings of some external investors in a particular stock may be more informative than the holdings of others, some insider actions are more revealing than others. Insider buy decisions seem to be more reliable indicators than sell decisions. Also, academic research suggests that the transactions of board members who are long-serving and live close to a company's headquarters are a better predictor of future company performance than those of other less well-connected directors. Similarly, the actions of very senior managers, e.g., CEOs and CFOs, may sometimes be less revealing than those of lower-level executives. Given their greater visibility, higher managements are more exposed to criticism for their transactions, and as a result, seem to be more circumspect in their behavior. It is important in using insider behavior for investment purposes to think in detail about which transactions will be most informative for any particular company. A careful review of the historical relationship between insider transactions and subsequent company performance is necessary to make the most of insider trading information. Another signal of management's view of future prospects is a decision to issue more equity either through a secondary market offering, an acquisition for stock rather than cash, or by enriching stock-based compensation plans. Academic studies over many years strongly indicate that issuing more equity is a negative sign for future returns. First, shareholder-oriented managers will not issue equity today if they expect their business to outperform current expectations in the future. In that case, they would raise funds through debt for near-term needs and sell equity at a higher price later, or simply defer external financing until the stock price improves. Second, rational managers should never sell equity when they think their stock is undervalued. These sales are a gift to outside investors at the expense of current shareholders. An equity issue usually signals the stock price is not undervalued and raises the probability it is overvalued, a fact that the market fully understands. Third, strong companies are better able to handle debt than weak ones, and there are usually tax advantages to debt financing. Therefore, the decision to raise capital by issuing equity suggests that a company is in a relatively weak financial position, or that, in management's view, its stock is overvalued. The specific choice of financing from among the full spectrum of options reveals additional information, long-term covenant-light subordinated to debt issues, which may carry higher interest rates, indicate greater financial weakness than shorter-term, more restrictive senior debt, which usually carries a lower interest rate. Like insider stock sales, the information conveyed by equity issues also depends on the context. For example, when overall stock prices are depressed, issuing equity is likely to be especially costly to existing shareholders. Under these conditions, usually going into or during a recession, equity issues have historically been rare. Companies selling equity at these times are companies with backs firmly against the wall, when the negative signal of an equity issue is especially potent. Investors should take this into account. A third and perhaps the most valuable source of information is the development of a network of able, like-minded investors whose areas of expertise complement your own. For example, a critical issue for those investing in small and medium-sized Japanese companies is the quality of the corporate governance and its treatment of shareholders. Japanese companies are often driven by internal operational imperatives for growth, employee welfare, and industry position, goals that may be laudable in themselves but leave little room for shareholder interest. In many cases, the shareholders of successful companies see little of the benefit of that success in the form of cash distributions. This behavior is not immutable. Anticipating favorable changes in shareholder treatment ahead of the stock market as a whole is a key part of profitably investing in small and medium-sized Japanese companies. But it is a difficult feat to pull off because, quite apart from rules against revelation of insider information, many Japanese managements are largely inaccessible to outside investors, especially investors without a significant presence in Japan. As a result, among the most successful investors in small and medium-sized Japanese companies are a group of foreign investors who have lived and invested in Japan for 30 years or more. These people have tended to gravitate to different Japanese regions within which they have developed close relationships with many local Japanese companies. Thus, even without access to inappropriate inside information, they are able to understand current changes in company cultures and anticipate the consequences of these changes for shareholders. A crucial aspect of their success is that they meet regularly to share information, so they are not limited to investments within a single region. They are also connected to similar investors in Europe and the United States, who have valuable perspectives on small and medium-sized companies in their own territories. The network as a whole enables its members to perform better than any individual member could do individually. Connection to these kinds of networks is an important part of an efficient and complete research process. Consensus public perceptions of a company's situation are useful in a different way. They do not provide active investment guidance, unlike outstanding investors, corporate insiders, or networks of able, focused, and informed investors. Investing with the herd will produce market returns at best. However, public perceptions are not always misguided. In many situations, average crowd consensus is a better judge than any individual. If you are going to invest with a view of the future that is contrary to those perceptions, a posture that generally characterizes value investors, it is still important to become familiar with the consensus point of view. Sometimes that perspective will include things that you have overlooked. These overlooked factors may often have no bearing on your original analysis, in which case no harm is done. But at times they will, and those cases justify the exercise. The value investors often declare that they consciously avoid Wall Street market research, which is a common characterization of broad market perceptions. Their fear seems to be that they will be negatively influenced by the siren song of the consensus. But genuine value investors should be able to look dispassionately at consensus views and reject them when warranted. For a disciplined value investor, there ought to be no downside to identifying the variant perceptions of the market crowd that differs from your own analysis. Finally, the investor should look carefully at his or her own prior behavior. A large fraction of value opportunities are created by the irrational behavior of Benjamin Graham's Mr. Market. The field of modern behavioral finance has identified a number of persistent common irrationalities, the exploitation of which are an important element of the search strategies we defined in Chapter 2. But irrationality is not confined to investors outside the value investing clan. Value investors are human beings, with all the same underlying instincts as non-value investors. There will inevitably be particular tendencies that affect all but a few inhumanly disciplined value investors that can lead to bad investment decision-making. The important thing is not to allow these tendencies to spawn recurring mistakes of either commission or omission. Mastering your own cognitive biases involves first identifying them and then developing strategies to deal with them. Identification requires careful monitoring. Every value investor should keep a record of decisions made to buy and to pass, to sell and to hold, with a note of the associated rationale. That record should be reviewed at regular intervals, at least yearly, to see if there are persistent patterns of behavior that undermine the processes and standards that the investor has established. Making a mistake once is excusable. Making the same mistake repeatedly smacks of carelessness, and this applies both to actions taken and not taken. Strategies for overcoming identified irrational behavior are many, but the simplest and most effective is to avoid completely those investment situations where you made poor decisions. The irrationality of others creates opportunities. Your own irrationality creates losses. Direct information. The efficient pursuit of direct information is rooted in the process of valuation. For fixed income investments with clear payoffs, usually senior debt in distressed situations, the critical issue is timing. You know what you are going to get. The only question is when. For example, if the payoff is face value plus accumulated interest at a known coupon rate of 5% with unpaid prior interest of 2 years, the immediate payoff would be 1.1 times the face value. At 1 year, the payoff will be 1.15 times. At 2 years, just over 1.2 times. If the bonds in question are bought at 90% of face value, the immediate return should be 22%, 1.1 divided by 0.9, and the rate of return would be very high indeed. At 1 year, the payoff is 28%, 1.15 divided by 0.9, which is also the annual rate of return. 2 years out, the payoff is 33%, but the annual rate of return falls to 15.5%. As the payoff recedes into the future, the return and the present value of the payoff, assuming the appropriate cost of capital is about 5%, decline steadily. For very long delays, the payoff may be unattractive. Unless there are issues of seniority or the ability of the company to cover the senior debt, timing is the most important determinant of the return, and thus the proper focus of active research. If there is a question of legal seniority, that also requires attention, provided the answers have a material impact on the potential payoffs. If the ability of the company to cover the senior debt is in question, then the circumstances under which this might be of consequence are proper subjects of active research. In both these instances, the research will be relatively narrowly focused. Complete enterprise valuations across a range of scenarios, especially optimistic ones, will usually be a waste of time. For businesses in competitive markets or regulated companies whose rates of return on investment are controlled at or near their cost of capital, growth is unlikely to create value. In these competitive situations, only companies with sustainable cultures of exceptional operating efficiency will make growth worthwhile to investors, and these companies rarely trade at bargain prices. For these companies, complex models of earnings, investments, and cash flow into the extended future will generally contribute little to identifying future returns. To the extent that these models show substantial benefits from higher growth rates, they are probably misleading and potentially harmful to sound investment decisions. At best, they demonstrate a misallocation of research time and effort. Efficient research efforts for non-franchise companies should focus on estimates of current asset and earnings power values. Yet these areas, especially asset reproduction values, are often overlooked as analysts focus on short-term earnings movements and future growth. The Magna International case, which focuses on the period following the financial crisis of 2008 to 2009, is instructive here. Magna, along with other automotive industry stocks, traded on the basis of earnings scenarios that were carefully researched but ultimately of little value. The North American automobile industry, including independent parts suppliers such as Magna, was going to be economically viable for a considerable time. The industry was also going to be highly competitive, as it had been for many years. This meant that future long-run profitability would have to support the reproduction value of the necessary assets. Some companies, such as General Motors, ultimately faced bankruptcy because the net reproduction value of their assets, net operating assets minus formal debt minus amount owed to suppliers, dealers, and workers, i.e., the book value of the equity, was well below zero. The companies were not going to fail immediately because the creditors, workers, dealers, and suppliers, had a strong interest in their continued existence. But ultimately, they were doomed, since those creditors could not afford to write off the debts that were growing steadily over time, and a negative net asset reproduction value will not support profits in the face of competitive entry. Yet very few analysts bothered to compute asset reproduction values, including the estimated value of intangibles for these companies. Other companies with positive net asset value also went bankrupt, because high levels of leverage meant that any sustained downturn would drive the value of these below zero. Again, very few analysts concentrated substantial research time on these downside balance sheet scenarios. Instead, they were focused on complex, forward-looking earnings projections that were unmoored from the economic reality of the automobile industry in the 2000s. For non-franchise businesses, a well-conceived research process should devote roughly equal time to asset and earnings power values, since they contribute equally to value determination. For franchise businesses, growth does matter, and asset values are relatively less important. Given this difference, the first research task is to determine the extent to which a company's operations are protected by barriers to entry. In principle, identifying the presence of barriers to entry is relatively straightforward, as we describe in Chapters 6 and 7. It is determining the extent, durability, and consequences of the specific competitive advantages that requires significant active research attention. The most important is a thorough understanding of the businesses involved, including the principal submarkets in which a company operates, either in physical geography or product space. The research needs to extend beyond the company in question to market variables, and most important, the financial performance of other firms in the industry. A lengthy industry history is essential, ideally extending over more than one industry cycle to identify long-term industry trends and any recent deviations from these trends. It is critical to determine whether current deviations are temporary or permanent. Conducting research at this level is a major undertaking, but it does have the advantage of being applicable to other companies in the industry that might later become potentially attractive value investments. The efficiencies that flow from this accumulated knowledge are a major argument for specialization. Once the nature of a business's franchise is well understood, the relevant quantities that should be actively studied again arise directly from the valuation process. The key value determining factors are 1. Current earnings power, 2. Distribution retention policy for earnings, 3. Organic growth rates in revenues and margins, 4. Active value creation, 5. Franchise fade rates, and 6. The cost of capital. Measuring items such as current earnings power and the cost of capital may be fairly straightforward, but others, such as active value creation, franchise fade rates, and even future distribution policy, will require a thorough understanding of the capabilities, strategic understanding, and priorities of management. Active research time and attention should be directed accordingly. The most difficult issue is the value created by active investment, although it is less significant for companies that regularly distribute 85% or more of their earnings, leaving little to invest. Management, activism, and catalysts. For both franchise and non-franchise businesses, management performance is central to both current earnings power and future value creation. Active research regarding management should be comprehensive. Good shareholder-friendly management performance involves more than just a high level of distributed earnings, which is the central demand of much show-me-the-money activism. There are 4 major areas of management performance. They are 1. Achievement of operational efficiency both in controlling costs and in areas such as marketing and product development. 2. The strategy for growth, especially capital allocation, which should avoid growth for its own sake and focus on those opportunities in which growth creates value. 3. Financial structure and the distribution of cash flow to investors. And 4. Human resource management. A complete management assessment looks at all of these areas. By far, the most important area is the pursuit of operational efficiency. A wide variety of studies, notably those financed by the Sloan Foundation, but including many others, have demonstrated that the most efficient firms in an industry typically have cost structures that are between 1/2 and 1/3 of the industry average. This represents a 100 to 200 difference in efficiency between leading and average firms. These differences exist even though leading firms typically have observable workforce characteristics, education, age, gender, and others, similar to those of other industry firms. Their levels of capital investment are also unexceptional, and leading firms tend to use seasoned rather than leading-edge technologies. The gap between the best and average firm efficiencies depends then not on resources, but on management's commitment to and skill in running an efficient organization. Although more difficult to quantify than costs, other studies tend to show comparable cross-company differences in marketing and R&D efficiency. Finally, leading firms seem to improve performance at roughly the same rate as less efficient ones. The average performers catch up to the leaders very slowly, if ever. The implication is that at any time, almost all firms could harvest large potential returns from a concentrated management focus on operational improvements. Managements that succeed will create considerable value for shareholders. For investors, the ability to identify such managements early on, before their qualities are fully appreciated by the market, should produce significantly better than average returns. Two identifiable characteristics stand out. First, achievement of operational excellence is a marathon, not a sprint. It requires constant attention to incremental improvement. This in turn calls for a management organization focused on driving such improvements, including a CEO who makes it a high priority. Sudden short-term interventions from outside agents, like the notorious Chainsaw Al Dunlop, rarely lead to long-term value creation. Second, in any company, the time and attention of senior management is a scarce resource. Those managers who embrace aggressive acquisitions or international expansion or promote their own public visibility rarely achieve operational excellence. Managements that focus effectively on operational performance will generally have simple, narrowly directed overall corporate strategies. The second important area of management performance is the growth strategy. As we have reiterated incessantly, only growth investments that produce returns above their cost will create value. This growth must benefit either from sustainable competitive advantages or long-term operational excellence. Since operational excellence only rarely generates significant growth, value-creating growth will generally be found in areas where the company currently enjoys sustainable competitive advantages. For starters, managers must understand where their competitive advantages exist, if they exist at all. The first place to direct growth is within those markets in which their existing franchise lies. When Walmart expands into groceries or Coca-Cola adds non-cola beverages to its product line, each is leveraging dominant existing local distribution infrastructures. When Microsoft adds features to its Windows and Office suite programs, it is leveraging both existing products and customer captivity. While widening moats through improved offerings, the judicious exercise of pricing power also represents value-creating growth within existing franchises. The next move for a firm is to expand into adjacent markets to which their core competitive advantages carry over. Historically, Walmart spread sequentially into adjacent geographic markets in which it could use its existing distribution, advertising, and management infrastructure. Oracle has followed a similar strategy in product space, adding industry-focused functional software to its central core of database management systems. Value-creating growth is more difficult to achieve beyond these two areas. Pursuing previously under-penetrated specific markets in a disciplined way may make sense if there is the ultimate possibility of dominating these markets and economies of scale and customer captivity are sufficient to convert that dominant position into sustainable barriers to entry. Trying to accomplish this feat in many markets simultaneously is a recipe for failure. Finally, attempting to compete in markets that have dominant incumbents in the hope of achieving the return enjoyed by them is a plan for value destruction. The reason that those incumbents earn sustainably higher returns is because their returns are protected from competitive erosion by insurmountable barriers to entry. A good management will pursue growth opportunities of the first two types. Pursuing growth without competitive advantages is a sign of poor management. Managers that direct their companies into global expansion without any clear rationale, except that globalization is the wave of the future, fall into this category. It also includes management who unthinkingly enter rapidly growing markets in emerging economies such as India and China, or in emerging technologies, because that is where the growth is. Without identifiable market-specific competitive advantages, such growth will not create value. Managers who regularly and enthusiastically announce initiatives of this sort are managers to avoid. A third important area of management performance to examine is financial resource management. First, if there is no obvious way for a company to employ financial resources at equal to or above cost of capital returns, then these resources should be distributed to investors through either dividends or share buybacks. The double taxation of company financial returns at the corporate level and later when distributed at the individual level is one reason for this policy. Potentially more damaging is the historical record that reveals sooner or later managers with spare financial resources will be tempted to put them to do something with them. If there are no good investments available, then they will make bad ones. These include undisciplined expansions that destroy value, or even worse, throwing good money after bad in futile attempts to rescue failing initiatives or struggling divisions within a company. Good management will remove this temptation by distributing those enticing piles of cash, and most activist investor interventions are designed to push them or their replacements in this direction. Another sign of good financial management is the acquisition of financial capital at the lowest possible costs. If debt is cheaper than equity, either for tax reasons, because, well, interest payments are tax deductible for companies, dividends are not, or market reasons, such as government intervention that produces distortedly low interest rates, then well-managed companies will prefer debt to equity finance. They still need to be prudent. Much of the cost of debt arises from the mere possibility of financial distress in which the imperatives of debt repayment materially impair the non-financial operations of the firm. This threat may undermine hiring, customer relationships, suppliers' cooperation, and public perceptions of the company well before formal financial distress occurs. But there are sensible levels of debt at which the possibility of distress is remote, where the consequences of distress are limited, such as tobacco companies with strong brands. Good managements in these circumstances will take on debt up to the limit where there is no potential for material interference with business operations. This policy, by lowering the cost of capital, will create long-term value for shareholders. Finally, investors should look for good or improving human resource management policies. A history of steady, non-cyclical hiring is a positive sign. Companies that add staff energetically in good times, when labor markets are tight, and then resort to expensive layoffs in bad times, when laid-off workers have particular difficulty finding other jobs, are serving neither their employees nor their shareholders well. Ultimately, it will make it harder to attract and retain a high-quality workforce, since, among other things, good workers are easiest to hire in bad labor markets. The result will be poor business performance. A second responsibility of human resource management is succession planning. Good management should have an orderly process for replacing itself. Without one, any management quality will be relatively short-lived, and its impact on value will be reduced. In assessing the impact of good management, it is important to remember that the past and current quality of management is already reflected in a company's financial performance. It is changes in management quality that have to be examined. Some change comes from gradual improvements in management performance and company culture, often as a result of a near-death or other adverse experience. This change will usually be visible in improving financials. The difficult question is one of duration. How deeply are the changes, for good or ill, becoming embedded in a company's culture, and how persistent are they likely to be? Other changes, also for good or ill, may be the result of new top management. It should first be apparent in shifts in management focus. However, unless the new management has a clear mandate for change and the resources to implement it, like 3G in the Heinz takeover, the results will emerge relatively slowly. Thus, there is usually time to assess the performance of new management before making a major investment. Changes of the 3G Heinz sort are generally the result of activist intervention. Investments made in anticipation of activist intervention, whether on the basis of an announcement of intent, in response to a company's concessions to an intervening activist, or in the face of an imminent activist takeover, are common among value investors and obviously worth considering. However, not all activist interventions are created equal. The success of activist investing for either the activists or those who follow their lead depends on understanding the likely outcome of the intervention. That rests on two elements. First is the likely response of the target company, whether it accepts or rejects the changes activists propose. The second is the quality and scope of the intervention, which will determine the size of any benefit if the target company responds either voluntarily or, after a change of control, involuntarily. The response is an issue of company culture, which varies from country to country. Asian companies are far less receptive to activist interventions than those in Europe. European companies, especially where there is a history of family control, are more difficult to budge than North American ones. However, even if companies manage to resist a full change of control of the 3G Heinz variety, there is a range of corporate responses. Some companies are rigidly opposed to intervention. They refuse to engage with activists and change little or nothing in their current practices. Systematic academic research indicates that for these companies, there is no significant shareholder benefit to activist intervention unless an activist is able to seize control of the target company. However, many companies do respond to activists and establish a constructive interaction with them. For these companies, there is wide variation in the level of the company's responses, but significant beneficial change can occur without a complete change of control. The nature of the change and the size of the benefit, which is our second element, depends critically on the motives of the activists involved. Activists who are narrowly focused on changing corporate distribution policy, pushing for increased dividends and buybacks, and attempting to intervene across a wide range of industries, produce on average the smallest benefit. Industry-specialized activists, those who have taken the time to become well-versed in the economics of their company's industries, and who are concerned with improving management practices across the board, are more likely to intervene successfully and provide the greatest benefit when they succeed. Paul Hilal is a model of this activist type. Investing in response to interventions by these activists will produce the best returns. Understanding who they are and where their expertise lies is an important element in successful activism-related investing. Activist intervention is one way that the underlying business value of a poorly managed company can be realized. Events that bring market prices into line with underlying values, such as takeovers, recapitalizations, and activist interventions, are referred to as catalysts. And a great deal of investment research among value investors is devoted to identifying catalysts. Some value investors will not invest in undervalued companies at all unless they can identify the catalyst that will cause the underlying value to be realized in the near future. Before devoting research time to identifying and analyzing potential catalysts, it is important to understand the role that catalysts play in different kinds of value investing. Benjamin Graham and David Dodd paid little, if any, attention to catalysts. Their importance was first made prominent by Mario Gabelli and other investors who rely on deal-based estimates of private market values to anchor valuations. Graham and Dodd had faith that although short-run prices are determined by the stock market acting as a voting machine, in the long run the market was a weighing machine, and intrinsic value would ultimately surface. In the meanwhile, an equity bought at a discount would continuously provide an above-market earnings return. Suppose an all-equity-financed non-franchise business has an earnings power of $50 million per year and an equity cost of capital of 10%. Its earnings power value, which should approximate its asset value, would be $500 million, providing an earnings return of 10%. If it were purchased at a price of $250 million, a margin of safety of 50%, then the earnings return would be 20%. Suppose, to keep things simple, all the earnings are distributed as dividends. Then the annual cash return on the purchase price of the stock is 20%. It would be nice if the price were immediately to jump to the intrinsic value of $500 million, but even without this move, the investment is an entirely satisfactory one. Moreover, if we were to sell it for $500 million, but could not find comparable bargains in which to invest the proceeds, $500 million invested at the 10% cost of capital would produce the same annual earnings return as our stock without the increase in price. Hence the relaxed Graham and Dodd attitude toward accelerating the convergence of intrinsic value and market price. Suppose that instead of distributing all earnings as dividends, our company's management retains and reinvests half of earnings. If it does so in a way that neither creates nor destroys value, the $25 million of retained earnings would generate $25 million of value each year, which would increase future earnings. The dividend return on our purchase price of $250 million would be 10%, $25 million divided by $250 million. But we would also receive another 10% worth of a valuable business whose future earnings and dividends we would get with no further investment. While waiting for the true value to surface, we would still be earning a 20% annual return. A problem does arise if management is a poor capital allocator and destroys half the value of the reinvested returned earnings. In that case, our returns will be well below 20%, and replacing management will be a more urgent task. A catalyst that can make this happen will now be of considerable interest. The importance of a catalyst to remove poor management will be even greater if an investment was based on asset value without a comparable earnings power value. Those assets in the hands of poor management are not producing an adequate current return, quite apart from any loss in the value of retained earnings through poor capital allocation. If management destroys half the value of the original assets, then our earnings return will be $25 million. If half of the earnings are retained, creating only 50 cents of value per dollar, the value of those earnings will be just $18.75 million, $12.5 million plus $6.25 million, a 7.5% annual return compared to a 10% cost of capital. Delay in realizing the value of those assets may wear away any original margin of safety. A catalyst will then be an essential part of a successful investment. This example illustrates the fundamental nature of catalysts. They are protection against bad management. If management makes good use of its assets and reinvests effectively, a catalyst is welcome, but not essential to a successful value investment. With bad managements, which in practice are often capable of destroying value at a breathtaking pace, a catalyst is essential, and the identification of catalysts should be an important part of any research process. A final word ought to be said here about value traps and catalysts. There is a persistent belief among some value investors that unless there is an imminent catalyst that will drive market price to intrinsic value, then the value constituting the margin of safety will be trapped and never be realized. These are investors who never invest without catalysts. For them, identifying and investigating catalysts is a central part of their research process. Given the Graham and Dodd analysis before, this outlook is misguided. For investments in companies that are well managed, value does not get trapped, even if the movement of price to full value takes a long time. True value traps are inextricably linked to poor managements. In that case, given the ability of bad managers to destroy value, it is a mistake to invest unless there is a clear, near-term prospect of management change. Otherwise, focusing heavily on catalysts is a distraction from other more important research areas. Other research process issues. There are two final points that need to be made about the research process. The first has to do with compulsive behavior. A compulsive attention to detail may be a useful asset for an investment analyst. Maybe it is the last rock that hides the secrets of either hidden value or hidden disaster. But in the real world of limited time, compulsive behavior can be detrimental. Before the outstanding investor Edward Lampert acquired a large position in AutoZone, he is said to have visited every one of its hundreds of stores. If more than an urban legend, this level of scrutiny would have been time-consuming and unnecessary. Visiting a carefully selected sample of 10% of the stores would have conveyed almost all the necessary information in a fraction of the time involved. Given Lampert's subsequent difficulties operating his Sears and Kmart stores, that time might have been better spent learning about the economic imperatives of retailing in general. Compulsive, formula-driven, active research will often lead to the collection of much information of little incremental utility at the expense of the pursuit of more relevant data. This criticism applies especially to investment companies that obsessively tabulate the number of their annual visits to company managements. Management interactions can be a useful source of information, but in a world of fair disclosure rules, the value of intermittent management visits has been greatly reduced. Public statements by managements about their strategies, their views of the economics of their markets, and their broad near-term prospects are widely and frequently disseminated. A careful reading of this record will usually provide 90% or more of what management has to offer. The reliability of these statements can and should be evaluated against the widely available public record of the management's past actions and performance. Meetings with management, which often require time-consuming travel, should occur only after the public record has been fully analyzed and any major points of ambiguity or uncertainty that remain have been identified. To calibrate the reliability of management responses to direct questions of this sort, it is useful to ask a number of questions to which you already know the correct answers. Questions that focus on competitive advantage and longer-term strategic thinking can provide important information about the future of the company. The topic of capital allocation is almost certainly a key part of this discussion. In practice, the most useful management interactions appear to arise from continuous, high-frequency contacts between knowledgeable industry analysts and a low-profile management. The second point about research practice concerns the kind of information sought. The Graham and Dodd tradition focuses on continuity and long-run value. Market opportunities often arise from adverse events to which investors overreact by treating temporary adverse changes as if they were permanent. The Graham and Dodd approach is to look at these situations and identify those where there is underlying stability. If they do forecast change, it is on the basis of well-established, long-term trends for which there is a record of years rather than months. A much more common practice is for analysts to attempt to anticipate change ahead of the market. Enormous effort is devoted to trying to forecast near-term earnings fluctuations, business and/or industry cycles, the arrival of disruptive technology, or the impact of the latest marketing innovations. Predicting the timing, duration, and magnitude of these changes is far more difficult than identifying stability. Serious recessions for either economies or industries are rare, probably less than 1 year in 7. Cyclical stability, therefore, characterizes the other 6 years. In addition, most recessions are temporary. The downward phase of a typical recession is 6 to 9 months long. The history of the global crisis that began in 2008 should reassure investors that apocalyptic projections are generally wrong. If a firm selling at 15 times earnings loses 2 entire years of